Hi, my name's Fred Arnold, and welcome to beautiful Southern California and the show Out of the Rough, a show that will help provide you some of the solutions to many of the challenges we all face during these tough economic times. Hi, welcome to Out of the Rough. I'm Fred Arnold, and in this show we'll highlight the opportunities and solutions to help get you out of the rough and into success, both financially and personally. In these tough economic times, I want to bring you practical solutions to many of life's challenges. On today's show, we'll talk about credit scoring and how you can improve it and how it will affect you when it comes to purchasing a home. But first, let's talk about some of the myths about the real estate industry and financing. One of the first myths that I get often when I'm interviewed, and that is it's almost impossible to get a home loan. Well, it is difficult, much more difficult to get a home loan than ever before. They do everything but take your blood nowadays. I mean, they really look into the situation because of past transgressions in the industry, because we weren't verifying a whole lot just 3 years ago, 2.5, 3 years ago, and because of the rampant fraud, they really investigate every part of your financial life. So the first thing I tell people is you need to be prepared with all your financial statements, and don't be surprised on what is asked of you next, because they'll verify your tax returns with the IRS. They'll verify that your Social Security number is really tied to you. They'll verify that the money that you say you have has been in the bank for 60 days. They'll scrutinize your credit report rather heavily. And so it's important to understand what your credit situation is and what your credit score is. So very important. Also, they scrutinize the property and they scrutinize the seller now. Because of flip properties and because someone trying to make a quick buck, they want to make sure they protect you and you're not buying a house that maybe is not worth what it's being sold to you for. The next myth that we hear is jumbo loans are no longer available. Now let's take a step back. You're probably, what is a jumbo loan? You know, jumbo shrimp, you got jumbo this, jumbo that. What is a jumbo loan? Well, let's break it down a little bit into 3 different lending amounts. The first is what's called a conforming loan amount, and that's a loan amount from basically zero to $417,000, and they call that conforming loan. And those rates are usually the best interest rates you could possibly get, and they're usually 30-year fixed, 15-year fixed. They're traditional loans. There's also 5-year and 7-year fixes in there, but their loan amounts up to $417,000. Then there's the class of loans that goes from $417,000 until $729,000, and that's called the high balance conforming. It's a new little bracket, if you will. And if you live in a high-cost area such as California, many of the communities are designated as high cost, and you can get a really good interest rate loan, 30-year fixed, 15-year fixed, up to $729,000. It's no longer a jumbo loan. And those rates are just a little bit higher than the conforming rates. And then there's the jumbo interest rates. And those interest rates are about 0.5% on average, or maybe even more, than the conforming loan interest rates. Now, let's talk about who does jumbo loans. It's usually investors or financial institutions. They're going to hold on to your loan for a long time. And we're finally seeing those that are buying a home well above $729,000. We're finally seeing that money come back to the market. And that's the jumbo market we talked about. That market all but kind of disappeared starting in the beginning of the housing crisis in 2007, and we're starting to see loans being done in that price range. So if you have quite a bit of money down and you want to buy a more expensive house, jumbo loans are back. Let's talk about buying a foreclosure and it being a great deal. Some people think that it's always a good deal. Well, the one thing about foreclosures is a lot of banks are pricing those homes below market, like much below market, to create excitement and to get a lot of people to bid on those homes. So we're seeing, let's say, a house that would normally sell for $500 be put on the market for $450, $425 to get 10 or 15 offers, to get people bidding on it, and sometimes that bid goes above what the fair market value is. So be careful based on that dynamic. Be careful. The other thing you want to be careful about is, since the seller's not living in that house, there's no transfer disclosure statement being provided by the seller. Now, the reason why that's important is the seller knows all the quirks about the house. They know everything about the house. They know about all the squeaks and all the bumps and bruises to your potential house, and they're required to disclose that. However, if they're not living there, they can't disclose that. So then, in that case, a real estate agent will make their best observation of the challenges that that home might have or the deficiencies that home might have. But when you buy a foreclosure, that's one of the biggest concerns, is you're not getting the perspective of the actual seller who's very familiar with the house. Another myth that we see is buying a short pay or short sale takes too long. What a short sale is, just real briefly, is when the seller is upside down. He owes $500,000, the value is only $400,000, and he can't afford the house anymore, and the bank's willing to take a little bit of a loss. Well, it takes a long time for those properties to be okayed for the bank to take a loss and to negotiate with the seller to allow that. And so the myth is it takes a really long time to get short pays approved. Yes, it is taking a long time. However, here's where you can shorten the time when you make an offer on a short pay. One is make sure that the transaction is being followed up on aggressively. Offer to provide any information that you need to provide so that when the bank gets your offer, they can make a quick decision. But the second thing that a lot of people don't think about is be the second in line on a short pay. Maybe you're not the one that was able to get the offer accepted by the seller, and you're not the offer being offered to the bank, if you will. Well, what if you're second in line? Because these short pays take 3 to 4 months, sometimes the original buyer backs out and finds a different home. If you're second in line, that property gets approved. A lot of times they can substitute you rather quickly, and you could be into escrow on a very good property, a property that may be below market value rather quickly. So don't be afraid to be the second in line, because a lot of times when offers are made on a short pay, the first person in doesn't buy the house because either they don't qualify or they buy a different home because of the time frame it takes for the first approval. Last but not least is the market will soon be full of shadow inventory. And shadow inventory is inventory being held by the banks. I think that is a myth. And the reason why is, yes, banks do have inventory. They have a lot of inventory. The only challenge is, in my humbled opinion, is if the banks were to liquidate all of the homes they had on their books, they might not be solvent or have the capital ratios required in order to stay solvent, in order to be okay with the regulators, to have enough reserves. If you take that loss all at one time, then those dollars wouldn't be available as reserves in the banking industry. So what we're seeing is homes being put on the market a little bit slower than they had in the past, so that those losses are spread out over time to the bank so they can stay solvent and they can stay healthy. And one last thing that people talk about is if a whole bunch of homes are dumped on the market at one time, it could depress the value of those homes rather quickly. So these are some myths or misconceptions that we see in the real estate market, and hopefully you provide this information and it's value to you. We're going to jump to a quick break, but when we come back, we'll be here with Fred Krieger, an expert in the real estate lending industry, and talking about credit scoring and how it can potentially affect you in purchasing a home.